Hey guys, so today I'm going to go over EPS or earnings per share. And I have to apologize beforehand. I've actually been pretty sick the past couple days, so if I end up coughing or if I have to take a drink of water, sip of water, I apologize. And if you guys haven't watched the past video, I highly encourage it. It's about price versus value. Price being what you pay for something, and value being what it's worth or what you would get. And that's really important because you can't take price at face value. But by using this, by teaching you the EPS, we'll get back there. You'll see it again, so don't worry if you haven't watched it. So today we're going to go over the EPS. Oops. The EPS, which is earnings per share, and this is really important. Not on its own, but we'll be using it again. So you have to know this. It's really simple though, and once you understand it, I guarantee you won't forget it. So we're gonna use it could actually get a little bit complicated. There's basic, diluted. We're gonna basically go over the basics. So which you let's say we have two companies. We have company A and company B, and company A will be our Apple or something, and what you want to find out is we're trying to find out how much of the earnings, how much they, what they earn is per one share of stock. So you got to kind of think of a company as a pie, and one share would be a piece of that pie. And when you buy when you buy some stock, you're buying pieces of that pie. You're buying a piece or you're buying multiple pieces. So that's why this is important. And what we're going to do is to be able to find that out, we're going to take the net income of a company. We're going to take the net income, and this net income can be over a quarter. It could be over a year. Uh, and it can actually be forward earnings, so it could be earnings that haven't been realized yet. We just think that, hey, the company may earn this much, so we can take those earnings too into account. But typically, when you're talking about EPS, you're talking about the past 12 months, which is earnings per year. That's how much a company would earn per year. So we're going to take the net income from the past 12 months, and we're going to say it's $1 for company A, or not $1. We're going to say it's $100. Still not much of a company, but Apple's been working hard, you know. And company B is going to be $300 in net income. And what we want to do is we want to figure out how many shares are in the company, because we want to figure out how much earnings are per one share. So we got to look at how many shares are there, or how many pieces to our pie. And I think it's really important when you first start out to just imagine it as a piece of pie, because that's basically what it is. And we're going to say there's 10 pieces to company A, so there's 10 shares outstanding, which means total. And company B is going to be 15 shares. And you can find this, if you guys don't know where to find this, maybe I'll make a video on that. But I use Google Finance. It's really easy to find. And basically what we're going to do with this is we're going to divide 100 by 10. by the total shares outstanding. And this is going to give us 10, right? It's going to give us 10. And that's our earnings per share. So what we're actually, it's $10 of earnings per one slice. Per one slice of that pie. So when you buy that pie, you're basically buying $10 of earnings. And that's how much your one share is earning, $10. And if we do the same for company B, we'll be getting 20. They'll be earning $20 per share, you know? And looking at this, we can tell which one's bigger. Well, company B is earning a lot more per share than company A. So you're more than likely to buy company B. And the thing to keep in mind is you're going to be taking price into a factor, into factor, because if company B is $200 per share, you're paying $200 for $20. But if company A is $1 per share, well, you're paying $1 for $10 of earnings. That's pretty good. I would buy that. So price is always important, and that's why we're going to go into price to earnings in our next video. So like I said, this is a really, really simple concept. Make sure you understand this, because we're going to be using this in the next video and slowly building upon this till we can basically value our own company. Then we'll get into more maybe advanced stuff. Not really advanced, but we'll be getting into like discounted cash flows and stuff like that. But simple for now. Definitely very simple. Please try to understand this. It's very, very simple. If anybody doesn't, you could go ahead and just leave a comment. I'll gladly help you. And please try to keep comments related to the video. But if you have any suggestions or you have anything that you actually want me to cover later down the line, go ahead and post a comment. I'll gladly make a video on it. But yeah, thanks for watching. Go ahead and leave a like, a follow, a subscribe, whatever. And I hope to see you next video.